Welcome to another lectures with me. I'm still remain your humble brother, Mr. Chinedu Rumba, alias Ctutors Nigeria Limited. Ctutors is still my academic name. So today I will be talking about basis of assessment in taxation. Yes, I've had a video like this, which is actually rival in YouTube. And the reason why I'm trying to add something to that video is because every day things changes. We have new things. We have so many updated version of things that have already existed. So there are things I want to bring into this course that will make this course a little bit more easier to students who are preparing for any examination. So this updated version of this basis of assessment in taxation will make everything now look very simple to you when you take time to go through this video from beginning to the end. Now, what is basis of assessment? Basis of assessment is the basis by which the tax authority tax every aspect of business. Yes, all registered businesses are exposed to tax. That one is compulsory levy by every business. So now, what are the bases for taxing the businesses? That is what we are talking about here. I want to let you know that the only technical thing I see in this topic is all about dates. Date is a crucial matter here. If you take your time to understand everything about mastering your date, this topic will be as easy as ABCD for you. What do I mean by mastering of date? When you talk about date, the way the accountants see date is not the way ordinary persons see date. Yes. In account, you have only two dates. Only two dates. Believe it or not. The two dates are 1/1 and 31st/12. If it doesn't end on 31st, we have 1/1 against 31/12. We have again 1/1 against 30th. Let's say we have 6. Because June stop at 30. December is 31. We have another date again that ends on 28/2 of every year. So I think these are the 3 dates that exist in taxation. It exists in accounting too. So now, I call all these dates just one date, depending on the month you are working with or the period you are talking about. So the tax authority know only the first day of the month and the last day of the month. That's all. There is nothing like 5th March in taxation. No, overruled. There's nothing like 17th April. You either talk about 1st of April and 30th April. Yes, it's acceptable in taxation. You either talk about 1st March and 31st March. So any other date you are talking about is out of network. So you need to master your date very well for you to understand this topic very well. For you to be able to work on this topic without any error, you need to be a date master. You're supposed to know that January stop at 31, February 28, March 31, April 30, May 31, June 30, July 31, August 31, September 30, October 31, November 30, and then December 31. Now, you have to master this. Yes. So many students cannot give account of this date the way I just pronounced it. It will help us a lot. Because if you make mistake of reading a wrong date, automatically the figure, the assessment will be wrong. Yes. So that is why I want to take my time now to teach my students on how to work with dates under basis of assessment. It will be easier for us to be able to carry out other analysis associated to this. But the first thing I'm going to teach you right now, or begin to teach you right now, is what I called mastering of dates. Now I'm going to present to you what will be guiding us in the date. The date is all about a period or one accounting year. Yes, you either say one period or you say one accounting year. In account, we don't normally say 1 year. We either say one accounting year or 1 period. All of them are the same. When we talk about 1 year, generally or by government, we see 1 year as January to December. But accounting depends on the date your business accepts to be preparing their final account. So if your business decides to be preparing their final account on 31st day of every month, 31st day of April, that means every 31st of April, that means the birthday for your business will take place. The way we normally do our birthday. So it happens in business. So every business have the date they prepare their final account. That date is very important to government, and we're going to work with that date right away. I want to show you some things that will make things easier for us. Now look at this date. We have January, of course, February, March, April, May, June, July, August, September, October, November, and then December. These dates they are usual in real life activities, January to December. Now, in taxation, under this topic, I want you to see these dates as left-hand side dates. Left-hand side dates. I'm going to produce another date on the right. I'm going to produce another date on the right. This will help us to carry out our 12 months easily, because we always talk about 12 months year, 1 year, 12 months. So you don't stop, you don't count your fingers for you to determine 12 months. You just look at this table, then it will carry you through. The table can be presented, you just study the table. It's a very simple table. Like this, from this January now, I've told you that this is the left side. Now, this side will start with December, January, February, March, April, May, June, July, August, September, October, and November. So now you see the dates are in two partitions. This is the left side date, this is the right side date. Now, what is the effect of what I have written here? Why did I have to put this? Why am I putting this? I want to help you calculate your 12 months in a twinkle of an eye. 12 months. In just looking at it, you know what 12 months is all about. Now, if you want to calculate 12 months from 1st February 1990, from this date, you need 12 months from this date. You don't have to crack your brain. Just think a bit, or call up this table. When you call up this table, this is 1st February 1990, and this is just February. This is February. February landed here, so that means you are taking this immediately to replace this. Since this is February, the next date you will see here should be January. Now, before you put up this date, I want you to know something. All these dates on the left, I call it the beginning date. So all of them is titled 1/1. Everything you see here should be 1/1. Whatever date you see here is end date. End date. All these are end dates. So it could be 30th, it could be 31, it could be what? 28. But all these days should be 1/1. Just like we see this February now. This is 1/2 because we have February. This is the first day of February. And we're going to take the end date of this January. So whatever date you are picking here, you are picking the end date. So this date, I'm going to pick up 31st I'm talking about February, so I'm going to pick up 31st of January. Now we're talking about 12 months ahead. I'm trying to count front. This is 1990, this is going to be 1991. So this is the 12 months. Why do we have 1990, 1991? Because it does not fall in January to December. The only place we have January to December, like the only place we have 1990, 1990 or 2000, 2000 is when, if this date is 1st January 2001, for instance. Now this is January 2001. If you need 12 months from this date, 12 months from this date will be January. This date and this date are the same. So the right date is going to be December. So we have 31st December. I will still take 2001. Yes, because it is from January. Anytime date falls outside 1st January, if this is 2001, this is going to be 2002. It happens consistently. Apart from January, that takes the same year. January takes 2001 to 2001. If you have something like 1/7/1990, you are trying to get 12 months from this date. 12 months from this date. 1/7 is July. You look for July by the left. July is this. So the end date will be June. And this June should be the last date of June. So we'll be having 30th June. This is 1990. This is going to be 1991. You are counting from left to right. Now at the same time, you can equally count from right to left. Yes, still follow the system. This is going to be your guiding angel. Whenever you're working with date under basis of assessment, this is what I teach my students that will help them to facilitate any analysis you are taking under basis of assessment, because we work with dates continuously. We work with dates. So I want you to master how to make use of the dates. Now, let's try to talk about the preceding date. Like you have something like 30th 11, maybe the year 2000. 30th 11 2000. Now, you want a date that will be here to give 12 months, because we always talk about 12 months. So you have to count 12 months back from this date. You don't need to crack your brain. You don't need to scatter your head. Come back to this table. This is 11. 11 is November. So you go to November. November is here. So simply take this date. We're taking December. And once we're taking December, remember that this is the beginning date. So it's going to be 1/1. 1/12. This is December. 1/12. Now this is the year 2000. This is going to be 1999. Yes, because it's not January. So 2000, count 12 months back, you get 1st December 1999. So this is 12 months, but you counted from right to left. Now let's say, for instance, you were given 31st July 2003, and you want 12 months back, because under this base of assessment, we talk about preceding year basis. Preceding year basis. That means a year before. Like here in 2003, the year preceding 2003 is 2002. A year before 2003. So that is when we normally talk about this, counting from right to left. So once you master how to count from left to right and from right to left, this course becomes very easy for you. Now, if you have 31/7/2003 and you need a date that will be here to complete this 12 months, simply come back to this table. This is July. You come to July. So that means the date that must be here must be August, and it must be 1 because it's on the left side. All the left side dates are titled 1. All the right side dates are titled either 30, 31, or 32 and 28. So now we're going to have, this is July, and we're going to put up August here. August is 1/8. Now this is 2003. This is going to be 2002, and so on and so forth. So when you master these dates with this process, things will be easier for us. This is your guiding angel. Now at this point, I'm going to take you back again to the rules and regulations under the basis of assessment. But before we talk about this, I want you to know that basis of assessment is talked about under section 20 of ICMA. Section 20 of ICMA 1961. This is where the tax authority established all the laws guiding basis of assessment. Section 20 of ICMA 1961. So what is ICMA? ICMA is Income Tax Management Act of 1961. That is where everything about basis of assessment is presented. Now, this law sees business in three major areas. We look at business in three forms. Number one, during commencement. Business under commencement. Business under commencement. Now the tax authority is trying to see a different way of taxing a new established business. Yes, new business, they have different ways of being taxed. It's not the way you tax an old business that you tax a new business. Now, I'm going to give you the rules and regulations under this. Then we'll talk about number two, the tax authority still see business under cessation basis. Cessation basis. When the business is trying to cease operation, or which you might call dissolution. Dissolution. They are trying to dissolve. So under this case, the tax authority still have a way to tax the business. Business is seen in three folds here. Commencement, cessation, and then the last one. Along the line, a business may decide to change their accounting date. So we'll talk about change in accounting date. Change in accounting date. So these are the three aspects whereby the tax authority see business existence. When the business is starting anew, which is commencement, and when the business decides to cease operation, how do the tax authority recover their money? How do they get their own portion of money? How much is payable as tax? How much is assessed to be assessed as tax? Is there? Then changing accounting date. A business that prepares the account on 30th June of every year may decide to change it to 31st of August every year. They have their own reason, and there's what we call election. Election is choosing between two alternatives. At times the business will choose, at times the tax authority will choose. We shall see how to elect under this, because you don't talk about election without talking about different methods of doing this. Yes, there are two major methods applicable to basis of assessment methods that should be applied here. We have the business method. They will have the government method. So these are the two areas. Business method, then the government method. Business method is called the normal basis of assessment. Normal basis of assessment. And then the government method is called the alternative basis. Alternative basis of assessment. Now, for some purposes, you'll be required to prepare the account using the normal basis, which is business method, and at the same time, you have to prepare the account again using the alternative basis, which is the government basis. Then, after doing this, election comes. Election comes here. Election. What do you mean by election? Because the figure you generated here should not be the same figure with this. If after the whole calculation, this place becomes 30,000 naira, for instance, and then this one becomes 34,000 naira, for instance. In election, you have to choose between 30,000 and 34,000, whichever that is greater. Now, under commencement, the tax authority will allow the business owner to choose to make this election. He has to choose which one he wants to be used for tax purposes. Now, as a businessman, you would like to pay lesser tax, so you choose the one that is lesser. If you choose 30,000, you pay lesser. If you choose 34,000, you pay more. So you will choose this. So business owners makes choice. They have the choice under commencement. So that is how it works. Then, under cessation, the tax authority will choose. the business will not choose there. Under the change in accounting date, the tax authority will as well choose. So here, this is the only place that the business owner will be allowed to choose. Now I'm going to still teach you how to make calculations under normal basis and how to make calculations under alternative basis, because both commencement, cessation, and change in accounting date, all of them have normal and alternative basis. So I'm going to take you up back to this section 20 of ICMA 1961. Now, as the name goes, commencement is in subsection 20, subsection 3. Then cessation is under subsection 4, and then change in accounting date is in subsection 5 of Income Tax Management Act. This is in this subsection 3 is where the rules and regulations were established by government on how business should be taxed. New businesses should be taxed, commencement. That is in section 20, subsection 3 of Income Tax Management Act 1961. So that will take us back now to what we call the commencement rules. We need to see the rules and regulations as established by government on how new businesses will be taxed. Then after that, we're going to look at cessation rules. And at the center, we'll talk about change in accounting date. So let's come to rules and regulations guiding how new businesses will be taxed under commencement rule. Commencement rule. Now remember that I told you there are two aspects of this. We have the business aspect and we have the government aspect. So the business aspect is the normal basis. Normal basis. The rule under normal basis is what I want to provide right away. Now there's what we call relevant years of assessment. Relevant years of assessment. Relevant years of assessment by government is the first 3 years of existence of a business. The first 3 years of existence of a business. So that means we're talking about year 1, year 2, and year 3 of existence of a business. That is the relevant years. So if you are to know the profit made under relevant years, if year 1 produced 3,000 naira, year 2 produced 5,000 naira, and year 3 produced 6,000, let's say 8,000 naira. So the profit made under the relevant years should be 3 plus this is 8 plus this is 16,000. So this is what the profit made under relevant years. Now, this relevant years is very important and very crucial as regards to these laws guiding commencement rules. These commencement rules should now be discussed particularly in part 2 of this video. So I want you to know that we are into training students at home. You don't need to be anywhere. You're going to be in your room and follow any course so long as you are in our channel. So always click on the subscribe button so that you get updated videos from Ctutors. So we're going to talk about commencement in the part 2 of this basis of assessment.